On November 10th, 2022, the US stock market recorded its best one-day performance in over 2 years. This was because of CPI data that was reported by the US Labor Department for the month of October. CPI refers to the Consumer Price Index, a tool which is used to measure the rate of inflation within the economy. October's rate of inflation was better than expected, which in turn caused the stock market to rally. But why? The answer lies in interest rates. Inflation and interest rates have a close relationship with one another. When inflation is high, as it has been for some time now, interest rates tend to rise. Global central banks have been increasing rates throughout 2022 in a bid to combat what has been the highest inflation in 40 years. By increasing rates, central banks are making it more expensive for both companies and individuals to borrow money. The kind of inflation we're seeing is the byproduct of too many dollars chasing too few goods. So, in the eyes of central banks, by increasing rates, they can limit the amount of dollars that people have in the first place through a higher cost of borrowing. That, in turn, will reduce demand and lower prices, in theory. This has some very clear implications for the stock market. When it becomes more expensive to borrow money, companies have less of an ability to borrow what's needed to fuel their growth. Additionally, companies who have already borrowed money are all of a sudden paying higher interest payments on those borrowings. Both of these factors result in lower market expectations for revenue and earnings respectively, which in turn hurts stock prices. If we think about the customers of companies, regular people with mortgages, they too are now paying higher borrowing costs on their mortgages and personal debt. If interest rates keep going up and up to reduce inflation, what's going to happen is that potential customers will be spending more and more of their paycheck on their mortgage repayments. That can result in there being very little left over for anything else except for the essentials, meaning there will be much less demand for non-essential goods, which is the intended effect of higher rates. Up until November 10th, the fear in the market was that central banks were going to continue to aggressively increase rates because inflation was showing no signs of slowing down. If that happened, it would be very likely that the global economy would enter a deep recession. Higher rates equals lower consumer demand, which equals lower corporate output. Lower output by companies equals lower GDP and likely higher unemployment, which is the recipe for recession. All of these negative expectations were priced into the market, i.e. stock prices reflected an expectation for higher rates and a likely recession. However, because the inflation data for October was better than expected, the market has become much more optimistic about the future. That optimism is now being reflected in stock prices, hence why the market is rallying. The reason why the market is optimistic is because there's now hope that inflation has peaked. If inflation has peaked, that would mean that central banks wouldn't necessarily need to be as aggressive with interest rates going forward. If that's the case, then the risk of recession goes down and expectations for future company cash flows go up. All good news for stock prices. There's also a very clear mathematical reason why higher interest rates spell bad news for stock prices. The price of every stock on the stock market is calculated as the present value of the market's expectations for future company cash flows. What we've discussed thus far are the various reasons why slowing inflation equates to more optimistic expectations from the market for future company cash flows. But slowing inflation is also good news for the formula which is used to calculate the present value of those future cash flow expectations. The formula in question is what's known as a discounted cash flow or DCF model. Central to the DCF model is the use of a discount rate, which effectively reduces the value of future company cash flows to recognize the fact that money earned in the future is worth less than money earned today. To make a long story short, when interest rates are rising, future company cash flows are discounted more heavily, which in turn leads to a decline in stock prices. Conversely, when interest rates are falling, future company cash flows become more valuable, which leads to an increase in stock prices. So if the market is now expecting interest rates to slow, stop, or reverse, that would spell good news for stock prices. This is especially true for so-called growth stocks because so much of their value comes from cash flows that are way out in the future, meaning they are much more susceptible to price swings in times when interest rates are volatile. So that's the main reason why the stock market reacted so well to the CPI data for October. This certainly is good news for American consumers and for anyone who has any investments in the US stock market. However, it would be naive to think that we are in any way out of the woods with regards to inflation and interest rates. This is especially true for Europeans as the energy crisis in Europe is much more severe than in the US, which is a major contributing factor to the inflation being experienced by many European countries. Interest rates rates are going to remain high for some time, as will inflation, which inevitably is going to and has resulted in slower economic growth, much slower than what we were experiencing before 2020. Regardless, if you haven't yet started your investing journey, you should do so now. And if you want to know how I would learn to invest if I could start over, check out the video popping up on screen now. I'll see you soon.